Hello everyone, and thank you for joining us for today's session. Limerick Chamber is thrilled to partner with Mazars Ireland to deliver today's webinar, Understanding SCARP, the Restructuring Alternative to Examinership for SMEs. We're delighted to welcome today's speakers, Tom O'Brien, Managing Partner and Head of Advisory Services, and Hilary Larkin, Partner Advisory Services, to cover today's topics. A special thank you to Josephine Barrell for all the coordination and support into hosting today's webinar. So just a few notes. Thank you so much for your understanding in rescheduling today's webinar. We had a few technical glitches on behalf of Limerick Chamber at the last time we tried to host this session. So today, please avail of that chat and Q&A feature throughout today's session. If you have any questions, we will address those at the end of the session. As you'll note, today's session is being recorded and will be circulated in the coming days. It will also feature in our newsletters, website, and the Limerick Chamber YouTube page. We hope you enjoyed today's webinar. And to begin, I would like to welcome Tom O'Brien, Managing Partner and Head of Advisory Services for Mazars Ireland.
Okay, good morning, and thank you, Caoimhe, for the introduction. I'm delighted to be here before you this morning presenting on SCARP. I'm joined by Hilary Larkin, who is a partner in our advisory area specialising in insolvency, and I am Managing Partner of Mazars and Head of Advisory. So I hope you'll find the content of our presentation today useful and informative. And maybe at the end of the session, if you have any questions, Hilary and I would be happy to take them. So maybe if we move straight into maybe an introduction to Mazars, just to give you a feel for who we are and what the firm does. We are one of the largest accountancy firms in the world at this stage. We've enjoyed exponential growth over the last 10 years to the extent that we now have offices in 90 countries with a staff complement of 42,000 delivering services on a full service line basis. So we are a little bit different than a number of our competitors, our larger competitors in the market, in that we operate on a fully integrated basis. So we are integrated both on a service line basis, a resourcing basis, and also on a financial basis, which is quite different to a number of our competitors who operate on more like a network system. So it really is a one firm approach, and everything we do is joined together essentially through our group organization. In terms of Ireland, we are a 3-office firm in Ireland. We are the 6th largest accountancy firm operating in the Irish market, with a staff complement of north of 500 and a partner base of 30 partners. We operate on a full service line basis, so we provide all the services that one would expect from a large accountancy firm. So that is audit and compliance services, tax services, consulting, and then financial advisory, which is quite a broad ranging area, moving from insolvency right across restructuring, corporate finance, transaction services, and general business advisory service. So really a one-stop shop for anything, any matter of relevance to your business. We have the skill set and partners that are able to handle anything that comes on your desk, and we'd be delighted to hear from any of you that have queries or issues of concern after the presentation. So maybe if we move to, just before we get into SCARP itself and the detail around SCARP, we might just look at the macroeconomic context, because really it's within this macroeconomic environment that SCARP will be relevant. And if we look back to 2020 and 2021, Ireland really has been operating in a bit of a suspended economy. It's been a COVID economy whereby a number of businesses, particularly in the SME sector, have been significantly disrupted as a result of COVID and the impact that had on business operations. So in the main, the 3 supports or avenues of support that were available to businesses were the significant government supports, COVID-related supports that the government made available to businesses. So they amounted to 13.5 billion in 2021, and were predominantly centred at employment subsidies. So whether it's subsidies to keep people on your payroll, even though they may not have been working, or subsidies whereby employers received the benefit of monies to help them with their wage bill over this period, right down to restart grants and CRSS schemes for those in the hospitality sector. But there's no doubt that the level of support that the government made available to the economy was unprecedented, such that if you look at the exchequer returns and the exchequer position, the country or the exchequer moved from being in a surplus of 1 billion in 2019 to a deficit of almost 13 billion in 2020 and 7.5 billion in 2021. So you can see from that the sheer scale of support that the government made available to the economy. Secondly, I suppose the revenue through their warehousing scheme became, to a large degree, the lender of last resort. And at September last, there was north of €3 billion of revenue debt that was warehoused. So that's debt that was out there owing by the taxpayer and by the SME community and business community at large, but had yet to be repaid. And a solution will have to be found to that down the road. Lastly, then, bank forbearance was a significant feature of 2020, 2021. And as at September 21, there was almost 5 billion of debt out there that the banks had offered forbearance on. And of that 5 billion, over 80% of that related to business loans, so corporate and SME loans. So you can see, as a result of the various supports, and particularly the revenue warehousing and the bank forbearance arrangements, it is likely that there is a large amount of businesses out there that are still carrying legacy debt from the COVID period. And that legacy debt, coupled with probably business model supports that are coming down the line for businesses that, because of COVID and because of changes in customer habits and business habits over COVID, there may be model changes that require restructuring. So all in all, a very fertile ground for restructuring, and indeed SCARP. And that's even before we get into other macroeconomic factors such as Brexit, changes in tax rates, inflation, Ukraine, and all of these factors are going to give rise to significant headwinds as we go out over the next period. Brexit, we've yet to see the full impact of Brexit because it hasn't been fully implemented yet, but certainly Brexit was causing issues with supply chain before we ever got into the COVID period. And also, we've no idea yet as to what impact that will have on exports, except it's not likely to be a positive. Inflation is much talked about at the moment, but very much affecting not only businesses, but consumers alike. And it's likely at some point, if all the economic commentators are pointing towards interest rates later in the year, and if that happens, and we have inflation running at the levels that we have, it's very likely that will feed into consumer demand at some point. So again, challenging circumstances for businesses. And then finally, Ukraine, we're already seeing with some of the businesses we're working with, the impact that the conflict in Ukraine has had on supply chain. And that is coupled with the supply chain issues that were coming from Brexit, are causing issues for businesses, and quite severe issues at this point in time. So all in all, between coming out of COVID and businesses trying to get their feet and trying to deal with their legacy issues coming out of COVID, we now are facing new challenges in the form of the various items I've discussed there. And this all makes restructuring, I think, a very topical theme. And our view of the world is that over the next 6 to 9 months, you are going to see an increase in insolvency and restructuring activity. It's on record, and the known fact that corporate insolvencies decreased by 30% in 2021. And by and large, that was down to the government supports that were available to businesses, we suspect. But given now that those supports are being eased off and we have these other headwinds, we fully expect to see an increase in that area. And that's why I think today's presentation is timely, because there's no doubt that when we get into that restructuring landscape, SCARP is going to be a very relevant tool to a lot of businesses out there. So maybe at this point in time, I'll hand over to Hilary, who will take you through the details of SCARP.
Thanks. Okay, I'm going to give a brief overview on SCARP over the next few slides. So SCARP is a new rescue tool which was enacted into legislation just before Christmas, and it's designed to give small and micro companies who are facing insolvency an affordable option to restructure. This happens through a combination of the write-down of debt and also the introduction of new investment into the business. SCARP on the main is based on the key components of examinership, but has some important differences that make it a more cost-effective and indeed a quicker process. Both SCARP and examinership have the same general principle, which is to restructure vulnerable companies to allow them to re-emerge and trade viably, and also to preserve employment. SCARP is aimed specifically at small and micro companies, and they are companies who meet two of the following three criteria. So firstly, the turnover must not exceed 12 million, or the average over the last 2 years. The balance sheet total should not exceed 6 million, which is the total assets on the balance sheet, and the average number of employees does not exceed 50. This actually captures almost 98% of Irish business. And on that basis, it's expected that there's going to be wide uptake on this tool as the economic factors that Tom went through come into play. So just moving on to the next slide, these are more of the qualifying conditions. So in addition to meeting the small company criteria, the company has to meet the criteria set out on this slide. So firstly, can the company demonstrate that it's either insolvent or it's likely to be insolvent in the short term? Is the balance sheet technically insolvent? The process advisor or insolvency practitioner will need to put this argument forward in his report. Another important condition is that there's an underlying viable business and that the company has a reasonable prospect of survival once there's a cram down of debt and an introduction of investment into the company. The company must also be able to show that there's no existing orders or resolutions for wind up in being. This is to prevent SCARP from being used as an exit mechanism for liquidation. And the only exception to that is if SCARP is implemented within 3 days of the appointment of a receiver or provisional liquidator. In those circumstances, the process advisor could go to court and get a stay on the applications. The company cannot have appointed a process advisor in the last 5 years. So in practice or in reality, SCARP can only be applied or used a maximum of once every 5 years. And similarly, an examiner can't have been appointed within the last 5 years. So just moving on to more of to highlight the differences between examinership. So examinership is open to all companies, whereas SCARP is open only to smaller micro companies, which meet the conditions that we've gone through in relation to turnover, total assets, and number of employees. In examinership, it's enacted by way of a court application, usually in the High Court, whereas SCARP is enacted by company legislation with oversight from the process advisor. So in theory, this eliminates significant costs relating to the court involvement. There's no solicitors required, or their input is a lot more minimal than examinership, and also there's no requirement for counsel. In some instances in SCARP, a court application will be required. For example, if there's a creditor action in being. In examinership, there's an automatic stay on proceedings, whereas in SCARP, there's no automatic stay and you have to go to court to apply for a stay if it's deemed necessary. In examinership, the timeline is 100 days, and this was extended up to 150 during COVID, but it's back down to 100 now compared to 70 days in SCARP, so it's a much quicker process. It can be a difficult time on companies, so the quicker that they can get in and out, the better. In examinership, there's no excludable debt, whereas in SCARP, revenue and other state creditors may opt out. Now, they need to have reasonable grounds for opting out, such as a history of non-compliance with tax returns, maybe an outstanding revenue audit, or an outstanding or ongoing appeal to a tax finding. In examinership, the court must approve the scheme, whereas in SCARP, the rescue plan is approved at a creditors meeting and the process advisor has to file a notice of approval with the court. The last, and I suppose one of the most important differences, is that in examinership, there's an automatic entry into liquidation if the scheme fails, whereas in SCARP, liquidation is not automatic, but it may be recommended by the process advisor if a scheme can't be implemented. So just moving on to pre-process planning. So careful planning is absolutely essential by directors, their accountants, and the process advisor is critical for careful planning is critical for companies to be able to successfully navigate their way through this process. So once the directors conclude that they're eligible for SCARP and they've met all the criteria, they prepare a statement of affairs detailing the financial position of the company, and they also consider the financial position if the company was in liquidation. They then need to make a statutory declaration that they have made a full inquiry into the affairs of the company and that the statement of affairs is a true and fair reflection of the financial position of the company. The process advisor then prepares a report similar to an IER or an independent expert's report in examinership, which sets out the reasons why the company qualifies for SCARP and also the reasons why they've determined that the company has a reasonable prospect of survival if it is restructured. So the report needs to include the items set out on the slide. So they are an outline of the nature and the prospects of the business, the availability of funding for the business, and it would be good at that stage to have a sense as to where the funding is coming from, the cost structure, including any cost savings they've already achieved and those that are planned for the protection period or for the period of SCARP, an assessment as to whether the company will be able to generate a sufficient return after SCARP to repay investment, the wider economic situation and its impact on the company. For example, is it impacted significantly by cost inflation, the war in Ukraine, Brexit, or other economic factors? The market the company operates in and its future prospects. Is there a new market condition that could permanently hinder the performance? The enterprise brand and historic performance of the company, the group structure, and the secured creditor's position. So if the process advisor cannot conclude that the company has a reasonable prospect of survival in this report, it's likely that the company will need to enter into an insolvency process such as liquidation, and that will be the recommendation within the report. If the company carries on and ignores this recommendation and ultimately goes into liquidation, the directors could face restriction or disqualification proceedings for ignoring the recommendation. So assuming that the process advisor's report concludes that the company does have a reasonable prospect of survival, the directors pass a resolution appointing an insolvency practitioner or process advisor and commence SCARP within 7 days of receiving the report. So just moving on to the process and timelines, we've just set out a high-level process chart and timeline of a typical SCARP. So we've allowed for a two-week time or planning period in advance of SCARP. So that's to allow for the process advisor to do the report and the directors to prepare the statement of affairs, call the EGM once and approve SCARP once the process advisor recommends it. So within 2 days of entering into SCARP, the process advisor is required to file a notice of the appointment with the CRO and the relevant court. And it also has to be advertised in Irisifpool and it must be noted on the company website. If there's a receiver appointed or a provisional liquidation application in being within 3 days of the appointment, the process advisor goes to court to have the appointment put on hold. But the court must be satisfied that the company has a reasonable prospect of survival in order to grant this application. The process advisor then notifies all creditors, including employees and revenue, of their appointment, seeking submissions of their claims with supporting documentation. Care must be taken in drafting these notices, as they could give rise, or they're an easy way to give rise to an objection by a creditor if not procedurally correct. Further reminders then are issued to the creditors in day 5 and day 12. If there's no engagement, the process advisor is entitled to determine the claim based on the company records. So it's absolutely in the creditor's interest to cooperate and avoid a scenario where they perceive their claim to be unfairly prejudiced. Revenue and other state creditors, as I mentioned, have an entitlement to opt out of the process, but they must do so formally within 14 days from receipt of the notice. And only if specific criteria apply. If they don't respond, then they're automatically included in the process. So from day 1 to 42, the process advisor has to have the rescue plan formulated and approved by the company, or to be approved by the company creditors. This rescue plan typically includes a write-down of the company debt and also a new investment into the company. So the process advisor must also report to the ODC or the DPP if any offence relating to the company is identified, and also if any concerns in relation to director conduct are identified during the process. So this provides a safeguard for creditors. Once the plan is formulated, the process advisor issues notices to the creditors and members and hold meetings with the various classes of creditors to present the rescue plan and to hold a vote for approval. So the meetings must be held by day 49 of the commencement of SCARP. The rescue plan is approved by the creditors if 60% in number, representing the majority in value of at least one class of impaired creditors, votes in favour. So that is 60% by number, majority of value of the creditors that actually are at the meeting are the creditors that have returned a proxy. The once it's approved by one class of creditor, the approval is across the ground against the other classes of creditors. So once approved, the plan must be filed in the relevant court within 48 hours of approval, and a notification of the approval must also issue to creditors within the same timeline. At this stage then, there is a 21-day cooling off period where either the creditors or the members can object to the plan. If an objection is raised, the process advisor has to go to court and seek approval of the plan. This could add materially to the cost of the process, and it's the receiver has to defend the process advisor has to defend the objection. The rescue plan then becomes binding if there's no approval within 21 days, or if the process advisor then issues a notification to all interested parties, including the CRO and the court. If the rescue plan is not approved, the process advisor must suggest an alternative or make an alternative recommendation to the directors, which, as I said, can include an insolvency process such as liquidation. So just moving on to the creditors' notices, it's important to note again that due care really must be taken in preparing these notices, as they're an easy way for creditors to object to the process if they're not procedurally correct. So I've set out the information on the slide that's required in the notice. Clear confirmation of the date of appointment and the appointment and the date of resolution. Details around any pre-appointment liabilities that have been deemed as critical to the preparation of the scheme. Proposed process payments required to fund the company during the process as a function that are critical to the survival of the company. Confirmation as to whether or not to what court the company has determined the jurisdiction for taking proceedings during the process. So it's either the High Court or the Circuit Court. Creditors are entitled to know this because they'll need to know where to object to if they need to. The process advisor needs to be mindful of minimising costs and will be expected to select the Circuit Court. However, there are some circumstances where they may feel that the expertise of the High Court is required depending on the specific issue. And there also may be issues around timings in terms of getting dates, etc. They also need to include the information around the value of the claim, such as the nature of the debt and security in the notice. The process advisor also is entitled to repudiate an onerous lease where it's deemed necessary to the survival of the company, and a court application will be required for repudiation if it cannot be agreed with the leaseholder during the process, which is likely. The process advisor must give notice to the leaseholder if they're proposing to vary or repudiate the terms of the lease in the scheme. Early engagement with these creditors is absolutely essential to have any chance of avoiding an objection. So there must be, as I mentioned then, the excludable creditors have 14 days to opt out, and if they do opt out or if they don't reply, their claim is automatically included. So just moving on to approval of the rescue scheme. Once the scheme is put together, the process advisor then holds the creditors' meetings to present the scheme and also to consider and hold a vote. The meeting notice must include the rescue plan, the details of the estimated outcome for the creditors, the estimated outcome in a liquidation, a statement of all costs and expenses of the process advisor. If the notice is not in the prescribed format, it will be deemed invalid and it will give rise to an objection. Meetings are held by class of creditor, and a quorum for approval is at least 2 members and 3 creditors entitled to vote. The creditors or the rescue plan will be approved when 60% in number, representing the majority in value of the claims of the claims represented at the meeting, vote in favour. The process advisor must then notify all creditors in writing that the scheme is approved and file a notice with the court. The rescue plan is only binding when at least one class of creditors impacted by the scheme accepts it, and the 21-day cooling off period passes when the date is filed with court and that there's no objection. So then just moving on to objections. The process advisor has 48 hours to file the notice with court after the plan is approved, and then the creditor or member has 21 days from that notification to object. Some of the grounds for objection are set out here. So they're things like the amount of loss or repudiation on an onerous lease is deemed to be excessive or not necessary for the survival of the company. The rescue plan itself is not deemed necessary for the survival of the company. The primary purpose of the rescue plan is the avoidance of tax. The rescue plan unfairly prejudices the interests of the objector. Other affairs or other creditors fare better than the objector, or a procedural error has occurred in the creditors' meeting, or that the rescue plan in itself was put forward for improper use. So it's important to note that the onus of proof in court for an objection will be on the process advisor, and that generally is held. That application will be heard at the end of the 21-day period. Okay, so then some safeguards for creditors. So the legislation in its current form contains certain protections for the creditors that act as safeguards to ensure that the scheme is fair and equitable in the absence of court supervision. So where the objection or where the scheme is objected, there's an automatic obligation to go to court. So that gives the creditors the assurance that the matter will be heard by a third party and will be heard in court by a judge. As there's no court supervision in general in SCARP, the process advisor will be subject to the same reporting requirements as a liquidator. And as a consequence, the directors will be subject to restriction and disqualification if there's evidence of irresponsible and dishonest director behaviour. The ODC will also have the power to examine the books and records similar to liquidation, receivership and examinerships, and it will be a criminal offence for directors to provide false or misleading information in SCARP, as a process advisor to a large extent does rely on information provided by the directors. Okay, so that's a high level overview of SCARP. I think Tom is going to talk about some of the key considerations of the process now.
Okay, thanks, Hilary. So there's quite an amount of the technical detail in what Hilary has just presented there. So what we sought to do on this slide is maybe summarize all of that in terms of what does it mean in terms of the practical conclusions and considerations if you're looking at your own case or you're looking at a case that comes across your desk in terms of SCARP. So I suppose the first key thing to take away from Hilary's slides are the importance of pre-planning. Okay, so the first thing I'd say is it is a very short timeline. So 49 days really moving out to 70 days, very short timeline. So it's really important that there's adequate and appropriate planning done before the process kicks off. Okay, and that's, you know, that will happen because you'll have the pre-planning reports and the pre-kickoff reports of the process advisor, etc. But I suppose when looking at planning, the key things that I would take from that are the importance of having up-to-date financial information and well thought out projections that reflect the current position that the business is in, the current run rate, and projections that give you a feel on a week-by-week basis for the cash flows of the business for that 70-day period, because you will need that to be able to understand what does the business look like for that period of protection. So it's probably safe to assume that all creditors will be delivering goods on a cash on delivery basis. So the fact that you're in this process will mean that your credit terms are null and void, and you'll have to be prepared to pay as you go in terms of supplies. There will be a number of what I call essential creditors or pre-petition liabilities. So these are creditors that, even though you're in a process that's likely to impair your liabilities, there will be certain creditors that you just cannot impair. And typically in an examinership scenario, these are the likes of utilities, because you need to switch your lights on every day, you need heating in the building. They will not take a write down, the utility provider, so you need to provide for payment of those. Creditors who have ROT, so creditors whose stock is held in ROT, that ROT amount will have to be discharged, so you need to have cash in place for that. And therefore, you know, all of those amounts need to be taught into your projections and need to be taught into your cash flows for that 70-day period. Also, if you are working on a COD basis, well, then your working capital flows may be different to what they traditionally are, okay? And they'll be different because, as I said, you'll be working on a COD basis. Your invoice discounting provider may or may not support you in the period. We're working on an examinership at the moment, and we are struggling to get the support of the invoice discounter because we're in that process. So that, you know, that needs to be factored into account. If you won't be able to release cash from your debtors, what does that mean for your working capital position? And then outside of that, there'll be costs to be paid. So, you know, the projections need to factor these amounts in, because ultimately, where does that lead you to? When it'll give you a feel for what you need in terms of cash and working capital in the period of protection, but also it'll help you work out what your likely investment amount is in order to get the company out of SCARP. And we'll come to it later. We have a case study prepared later on that shows you how you might go about calculating the likely investment amount. But again, that calculation is key to your pre-planning, because if that throws out a figure that just is unrealistic or can't be sourced, well, then that might put a different view on on what restructuring option you choose. And then finally, the attitude of key stakeholders. So when I think of stakeholders, I talk about creditors, I talk about the revenue commissioners, and your financial institution if you have secured debt. Very important that you understand the attitude of those three parties. If your creditors are likely, or if you have essential creditors who are likely to view the process negatively and maybe cease supplying, and if that has issues then for your production chain and your ability to service your customers, that needs to be taken into account. Your history with the revenue commissioners and their likely disposition to the process. They have grounds, there's succinct grounds upon which they can refuse to support your proposal, and those grounds reach out into, as Hilary said, your history of tax compliance. Is there an ongoing revenue audit in place? That needs to be thought through. So if you feel you won't have the revenue commissioner's support for whatever reason, that may well be a very significant issue upon which, whether in terms of deciding whether you enter SCARP, because I suspect a large number of companies that look at this process will be looking to reduce their exposure or write down some of their warehouse revenue liabilities. And if that isn't possible because maybe the tax history of the business is checkered or whatever, that's important to know that at the outset rather than get into the process and find it to fail. And then finally, if you have a secured lender, I suppose the attitude of that lender to the process is important. Clearly, the process, removes the secured lender's position to appoint a receiver for a period, but in my view, it would always be better to approach your lender and have an open and transparent dialogue with them. Let them know what you're doing, because in many cases, you may not be looking to in any way compromise the secured debt position of the lender. But again, very important that you'd have that conversation, because the last thing that banks like, and it generally makes them nervous, is surprises. So you're better off having given them the heads up before you enter the process. Creditor engagement, I've mentioned the issue in terms of the importance of getting your creditors on board, both in terms of ongoing supply, and the impact, that knock-on impact that can have on the business. But I suppose my recommendation on whether it's SCARP or examinership would always be that there should be lots of communication with your creditor base, and that should be timely and regular, very open, transparent, explaining to them why it is that you are where you are, what does the process mean for them, you know, the likely haircut amount, what the business will look like afterwards. And it's important that the creditors don't feel that there's anything hidden, that there's something there that they're not being told. So I'd always favor open dialogue and early dialogue, you know, and then continual updates throughout the process. And remember, if you do that, and the more transparency and accountability that you bring to the matter from the offset, you're likely to reduce the number of objections you get. And it's really a matter of bringing your creditors along with you, and I can't overemphasize the importance of that. Remember, also, as Hilary has pointed out, objections have got the ability to delay the process, add cost to the process, and ultimately derail the process if they're successful. So it's important that you try and minimize those. Excludable creditors, we've spoken about that. They are the revenue and other state creditors, and they have got that opt-out. And again, it's just important that, you know, you form an educated view based on your particular circumstances as to whether the revenue are likely to be an issue, because if the revenue are not on board, it may undermine the business case for entering SCARP in the first place. Next point, I would say, just again, very practical point, is if you do get objections and you have got to go to court, the jurisdiction, court jurisdiction that you select is important, because circuit court versus high court, they're two different animals from my experience. And if you go the circuit court route, you are exposed to the vagaries of the circuit court system, which means you may get a judge that is more criminal than commercial, and you run the risk that you may not get the decision on certain items of commercial importance that you're looking for. And I have been involved in cases where we were unlucky in terms of the outcome we got on some stuff, because we just didn't get a judge that maybe fully understood the commercial ramifications of the issue at hand. And then there is also a timing issue in terms of getting your slot in court, and circuit court can be that bit slower. In terms of onerous contracts, so particularly leases may well, and landlord rental arrears may well be a reason that SCARP is selected. The one thing I would say on that is that leases can be repudiated, but will involve court engagement. And therefore, I suppose a chat with the landlord to understand their position of where they're coming from early on would be important. But if you have a landlord that's obfuscating on the matter, you will end up in court if you want to repudiate that lease. And then the last thing, which we always get a question on, which is the position of guarantors, either in examinership or SCARP. And it's very important that people understand that if you have got personal guarantees out in relation to a lease or your bank debt, etc., the rescue plan and the process does not affect those personal guarantees. Now, the one thing I would say, if you are a secured lender or somebody who is relying on a personal guarantee, if you want to be able to pursue the guarantee and pursue the guarantor for the amounts falling due under the guarantee, it is absolutely important and critical that you give the guarantor the opportunity to vote at the creditors' meeting. If you are a secured lender, or you hold that guarantee from somebody and you vote at the meeting, well, then you undermine your ability to pursue that guarantee. And that is, can't overemphasize the importance of that. It's an important thing to remember and take advice on before you attend a meeting. Okay, so I think they're the practical issues. So as I said, planning, creditor engagement, knowing where you stand with the revenue, how to deal with owners' contracts and the guarantee position are all the practical conclusions that I would take from all of the slides that Hilary has presented. What we have sought to do on the next slide is try and bring some, I suppose, some context to the legislation, and to show on a very straightforward basis how does SCARP work and what does it mean in terms of a distressed balance sheet and what your balance sheet might look like when you come out of SCARP. So I suppose this is a very straightforward example. So we have a company that has a turnover of 2 million, total assets, which is the company's definition of total assets. So it's not net assets, it's fixed assets plus current assets, okay? And then number of employees, 10. So if we look at the test that Hilary had presented earlier in the presentation, so you must, for 2 years running, to qualify for SCARP, you must be deemed to be a small company, which is a company that turns over less than 12 million, has total assets of less than 6 million, and total employees of less than 50. So in this case here, the company ticks the box on all of those 3 conditions, and it's been ascertained that the business was a viable business before COVID, and there still remains an underlying viable business, but there is some legacy liabilities existing in the company that need to be resolved in order to put the company back on a solid footing. So if we look at that balance sheet there, fixtures and fittings, buildings, about €1,075,000, current assets comprising stock, debtors and cash of 685,000, and then current liabilities of 2,050,000. Now there's a bank loan in there, but if you're to strip out the bank loan, you're still back to 1.15 in current liabilities against current assets of 685. So you can it's clear to see there is a liquidity problem within the business. The current liabilities exceed the value of the current assets, and overall there's a deficit on the balance sheet, which is the key criteria in looking at something, whether they qualify for SCARP or examinership. That deficit position and balance sheet insolvency test is always important that you meet that. So in this case here, the business meets the balance sheet insolvency test, and on the basis that it ticks the various conditions that are required under the Companies Act and has a viable business, it qualifies for SCARP. So if we maybe go to the next slide, we can see the impact then of SCARP in terms of this business. So what we sought to do is we've set out the business in terms of the statement of affairs on a pre-SCARP basis. So that's the very left-hand column there. And that is the business as it currently stands now. And then we've sought to set out the outcome for creditors in a liquidation, and then how they might fare in SCARP. So the underlying premise in a SCARP scenario and examinership is always that the creditors must fare better in SCARP or examinership than what they would do in liquidation. If they don't fare as well or better in SCARP or examinership, the default position is liquidation. So if we run down through the various balance sheet components there, you'll see that the net position for the land and buildings is about 100,000 of equity. So there's 1 million of value and 900 of debt. And so the statement, the proposal in a liquidation there, the outcome for the bank in a liquidation is they most likely would appoint a receiver, they clear the 900,000 and they'd realize 100,000 from the process. The position in SCARP would be, in this example, we'd be suggesting that the bank would be spoken to, revised terms would be agreed, the debt would be kept whole. And so the outcome for the bank in SCARP is also 100,000. If we look down at fixtures and fittings, in a liquidation scenario, the fixtures and fittings would be sold, probably at a discount. The amounts due under finance leases would be handed back or sold, and there'd be a net outcome of 5,000 in a liquidation. In SCARP, again, similar to the bank situation, it is most likely that an agreement would be arrived at with the finance lease provider, whereby payments probably would be suspended in the SCARP period and resumed post SCARP. So on a net basis, no difference in SCARP, 25,000 net still owing. We look at the trade debtors, and in this case, there is invoice discounting facilities in place. So the current net position with debtors after invoice discounting is 200,000. It is likely in a liquidation scenario that there would be difficulties collecting, because there always is in a liquidation scenario, collecting your debtors. So we've estimated that the debtor book would realize, after repaying invoice discounting, would realize a net of 60,000. And on SCARP, obviously the invoice discounting is kept whole and continues to be collected throughout the period, so therefore no change in SCARP. Cash at bank stays the same throughout all 3 scenarios. And then stock, we've looked at on a liquidation basis, we've assumed there would be a write down of stock and that ROT would be repaid, but to be a net receivable on stock because of having to sell stock in liquidation always sees a discount being applied. So net position in liquidation 37.5, and again no change in SCARP because the business continues on, retention of title gets paid in the period, and you're left with 125,000. So when you look at the asset side of the business, and you look at the balance sheet as we see it now, and the balance sheet that would likely come out in SCARP, you will see there is no difference, because the business trades on within SCARP and all debtors continue to be collected. Stock continues to be turned, ROT administered in the way it would always be administered and paid. So no change to the balance sheet in a SCARP scenario. So really, it's in the liability side of things that everything changes in SCARP. So if we look at the below the realizable value of assets line, you have first line item is restructuring costs, and again, you'll see there's 40,000 provided in the restructuring costs in a liquidation scenario and 30,000 in SCARP. Okay, so why is the realizable value of assets important to show in liquidation? We're trying to set the baseline for what creditors will get in liquidation. So if we look at the liquidation amount, the liquidator will have realized 212,500 from the proceeds of the liquidation, and he'll have liquidator costs of 40,000, which are preferential in any liquidation. So that leaves 172,500 of funds in the liquidation, which in order of priority, the first and only creditor that would get any dividend in a liquidation is the revenue. So the revenue in this scenario are owed 325,000, of which 200 is preferential, because the last 12 months of revenue debt is preferential. Okay, so they rank above unsecured. So in this scenario here, we've stripped out the preferential revenue position from the overall revenue position, and at the on the first page there, the first page of the example, we showed that the revenue were owed 325, 200 of that being the last 12 months is the preferential piece, and in a liquidation, only 172,500 of that would get repaid, because that is what's available for the liquidator after costs. So that's your starting point for SCARP. The revenue will get 172,500 in liquidation. They will get nothing on their secured unsecured piece. And if we move down the other class of creditors, the unsecured loan will realize nothing in liquidation. And the trade creditors, excluding retention of title, so there was 500,000 of trade creditors, the 325 excluding retention of title will also get nothing in liquidation. So there is the base point for SCARP. All creditors now, in terms of the revenue, must do better than 172,500, and then the unsecured lenders, the unsecured revenue piece, and the trade creditors must do better than zero. Okay, so the process advisor and the company will look at this, I'm sure, when they're planning the matter, and they will understand that the revenue must get 172,500 plus a piece on top of that. So in this example here, we are assuming that all parties would be given, all unsecured parties would be given 3% on the amounts owing to them. And that would be, broadly speaking, dividends in matters such as this will go anywhere between 1.5 cents and 5 cents. So we picked 3% for this. So in this example here, we're giving the revenue 172,500 plus 3% of the preferential amount in SCARP, so 177,675. We're giving the unsecured loan advancers, they're owed 100,000. We're giving them 3%, which is 3,000, and then the trade creditors of 325,000. We are giving them 3% of that, which is 9,750. So all in all, that proposal sees the creditors fare better than what they would in liquidation, because if we run down through them, the revenue between their unsecured and preferential dividend are getting about 181,000, being the 177 plus the 3,750. The unsecured lenders are getting 3,000 as opposed to nothing in liquidation, and the trade creditors are getting 9,750 instead of 325. So the net effect of all that is that the balance sheet moves, if you go to the left column, from a negative position of 290,000, so that is the figure, the net deficit that we had pre-SCARP, into a positive position of 235,000. And there has been a swing there of about 520,000 as a result of SCARP, and 145,000 of that has been a write-down of your revenue liabilities. There's been 97,000 of a write-down in your unsecured loans, and about 310 or 15,000 in reductions in trade creditors. So the balance sheet has been completely right-sized by over 500,000. And the cost of doing that to the company, the upfront cost of doing that to the company, has been the various figures there, the 30,000, the 177, the 3,750, the 3,000 and 9,750, okay? Now, what I would say when I talk about upfront cost, it is most likely possible that you would get an installment plan with the revenue. Now, I would suggest for the 177,000, I would suggest that an upfront payment of some description would be required with the balance to be phased out. But in broad terms, if you assume that all of the revenue debt was put on a restallment or an installment arrangement, the upfront funding requirement in this case is about 46,000, which is the costs and the various dividends to the unsecureds. Now, that figure is obviously before you take into account any working capital requirements in the process, because it, as I said earlier, depending on your cash flows for the period of protection and depending on what way your working capital is running, in circumstances where you have to pay for stuff on a cash on delivery basis and you may have pre-petition liabilities, you may well have to bring an additional amount of cash into the business to fund working capital. So the 46,500 that we've mentioned there, that is a baseline figure. I think you would have to allow for an amount of working capital, and you most likely would have to allow for a down payment on the revenue piece, because I think it wouldn't be unreasonable to assume that they would expect that. But outside of that, you can see it's a very efficient process. The write down of creditors has had the effect of transforming the balance sheet, and that is why I think when you look at a number of these businesses, of these smaller SME businesses, I think SCARP will be a very attractive option to a number. Now, there will be the question of, can you get investment? Can you raise the amounts here? So if we assumed in this amount that there's 46,500 of cash needed up front before you take account maybe of 50,000 of working capital, maybe another 50,000 of down payment or revenue, say 150,000, can you find an investor, or has the promoter got the wherewithal to raise 150,000? So that, if you're to look at risks or downside here, it's the promoter's ability to raise investment. But given the fact that there is such a transformational effect on the balance sheet, I suspect that many promoters will find that money, because it makes absolute commercial sense. So I'm happy to take questions. I know when Hilary was talking there, I could see that Stephen McCarthy, I think, who's in the invoice discounting area, raised a very valid question in relation to ID and the role of ID in this process. And it's a very good question, because I'm a strong believer in, particularly in examinership scenarios where companies are that little bit bigger, maybe the debtor books are a bit cleaner, but invoice discounting has for a long time been a really effective way of raising finance in an examinership scenario, and continues to be. And there are a number of providers out there that actually like an examinership scenario as a means of pushing invoice discounting into a company, because it really is an effective tool. So I'd absolutely agree, Stephen. ID has a huge role to play in circumstances where funding is required in order to get the company out of the process, and that the debtor book is, I suppose, compatible with a product such as invoice discounting. So yes, absolutely, it's one of the first ports of call when you're looking at raising finance, is the ID side. I see there was another question there just came up on my screen in terms of how does the dividend get arrived at, and well, I hope I've explained just on the example there. I mean, the dividend is really a function. The first thing you do in looking at the dividend is, how do the creditors fare in a liquidation? And so, as we've established there, you look at what would the assets of the company realize in liquidation. So that example was 212,000. You look at what your likely costs are, and then you distribute those net realizations out across the various creditor classes in order of priority. And that determines the baseline. So if you've established, as in that case there, that the revenue are the only party likely to benefit from a dividend in liquidation, well, that sets the baseline for the dividend, and anything above that is an improvement on the creditor's position, and generally that is the bar and the threshold for deciding your dividend. So I hope that's clear. I'm not sure if we've any further questions.
There's just one other question there. Can the same insolvency practitioner prepare the pre-appointment report as well as the rescue plan? So they can in SCARP, which is different to examinership. So your process advisor in SCARP can prepare the pre-appointment report as well as run the process. I don't think there's any more questions. There's one there.
We have one more question there, just in terms of what are the factors to be considered in calculating the investment amount. So generally speaking, there are 3, if not 4 factors. One is how much cash do you need to keep the business afloat in terms of working capital cash. Second is how much cash is needed to pay your pre-petition liabilities, so your liabilities that arose on the date of appointment. So you need cash to discharge either ROT or essential creditors. The next point is cash that's needed for paying your costs. Okay, so that also needs to be factored into consideration. And then the last point is your dividend. So I'd say working capital, pre-petition liabilities, costs, and dividends. The sum total of the 4 of those are your indicative investment amount. And then the last piece is what happens if the process advisor recommends liquidation. Hilary, do you want to handle that?
Yeah, so if the process advisor recommends liquidation, the company doesn't actually have to take the recommendation, but if they ignore it and they continue to trade and ultimately end up in liquidation, they will face or they may face restriction proceedings in the liquidation.
Okay, so I think that brings us nicely up to the hour mark nearly, and brings us to the end of our presentation. On behalf of Hilary and I'd like to thank you all for attending. I hope you found it informative. I know there's a lot in it, but we are available. Quiva has our contact details there and can pass the slides on, etc. But if you have any questions you'd like to take up on a one-on-one basis, we'd be delighted to speak with you. So again, thanks very much for your time.
Thanks so much, Tom. And just on a note from the Limerick Chamber, thank you so much for partnering with us on today's webinar, and special thank you for such wonderful presentations. There are definitely some insights there we can take away from. So for anyone who is interested, today's session was recorded. Should you wish to reflect on this or share it with your teams as well, we will be sharing it in the coming days. And like Tom mentioned there, we'll be sharing the slides and the contact details. If you do have any special questions or queries for today's speakers, or you want any additional supports or information. So once again, thank you so much, and I hope you have a lovely day.
Okay, thank you very much, Quiva. Bye.
Bye.
Bye.